Before we start, before I invite my fellow panelists to join us, I want to say a little thank you, if I may. First, to our sponsors, to Moody's, to Main Street Partners, our top sponsors for the day, but also to BNP Paribas, to Luxembourg Green Exchange, stall out there, to QSIP Global Partners, QSIP, part of the underlying engineering of the bond market, to Ashurst, to the CFA Society of UK, to Scotiabank, and there's a whole delegation here from them, to Mizuho. There's a great guy from Mizuho working on transitions. Put your hand up. Where are you? Thank you. And to the International Capital Markets Association for their support for this conference, critically important. I also want to say a special thank you to the team. These events only happen because of this amazing pool of people that have created this event. So to Claire Burson in the front row, to Irina, our conference organizer, wherever you are in the room, there at the back there, to Gaia in the conference team, to Alicia Bastos, our head of events, to the whole communications team that have been slaving their guts out, especially today with constant posting, but to all the staff at Climate Bonds who've put in all sorts of ways to make this happen. These are big affairs, as you know, and it certainly takes a village at least to make these happen. In this case, it is a joy for me that there are so many people working on this and so many people doing excellent work. And also thank you to the venue. That's the background. Yeah, give him a clap. Thank you, Mahesh. This market has seen extraordinary growth since we began in 2009, when there were less than $2 billion outstanding of green bonds. We now have in the green, social, and sustainable bonds upwards of $4.3 trillion US. When I first met the man in the second row there, Mahesh, at State Street Global, some 13 years ago in Boston, it was a twinkle in the eyes of some of us. Mahesh was one of those few people at State Street who got it immediately and said, fantastic. The rest of State Street was saying, yeah, sounds good. We'll come back to you. Now, of course, State Street are fantastic supporters of this work, and we're very thrilled to have people from State Street Global here today. And Mahesh, in the meantime, is doing good work in Boston. There's a journey. Well, there are other people that have been part of this journey. I want to invite a couple on the stage. I'd like to invite Agnes Gork from BNP Paribas Asset Management to join me on the stage.
Actually, not the asset management, because you'll be disappointed.
Sorry. Sorry. You see, the problem is the other organization, BNP, I'm speaking.
We are very big.
I'm speaking at BNP Paribas Asset Management's events all the time, including next week, and I keep getting confused. Sorry, Agnes.
We'll invite you more.
But hey, it's a group, right?
It's a group.
Thank you.
No, but there are rules, so we are the asset management.
Compliance is everywhere. Luckily, I don't work in a bank. I don't have to worry about compliance, do I? Do I?
They'll be in trouble, yeah.
You'll be in trouble. Luckily, I'll probably be all right. And then I want to invite Pietro Sette from Main Street Partners, which is an investor. You can explain. We're having a discussion. Will I get the description of Main Street right or not? Pietro's going to fill us in. And then I want to introduce Jarek Olzoka. Sorry, Jarek, I always get confused, but Head of Sustainable Finance at Nomura, who's online, who's been unwell, who we're lucky enough to get joining us online. We're going to have a bit of a discussion today about opportunities in fixed income. Well, I mean, clearly we've made progress. We've had some wins. But as I said earlier, we've got a long way to go. Where, according to the Climate Policy Initiative, we've seen about $1.5 trillion of capital go to climate solutions this last year. S&P thinks we're going to hit a trillion, I should say, of green bonds issuance this year, which is great, but it's a few years behind. However, the capital that we need is something like $10 to $15 trillion a year. I mean, it doesn't all have to be labeled, don't get me wrong, but you get a sense of the scale here that we've got to achieve. So we are, as we heard earlier, arguably at the beginning of the J curve, in the armpit, but we've got to actually make it much bigger. So the question is, what's the appetite amongst investors? Where's the supply coming from? How are we going to do this? What do we need by way of regulation? What are we getting? This is the point of this session. We're going to have a bit of a discussion of our three speakers, and then I'm going to be asking for comments from the audience. But Agnes, I might start with you. You've been working on this for a long time.
No, it seems so, actually. But it's, first of all, it's a pleasure. And, you know, I mean, there are a lot of very knowledgeable people on the topic in the room. So that's always a challenge to come and speak at the event here. But I think in terms of investor demand, I would say, and we were talking to Caroline, one of your colleagues earlier on, you always see, you know, the best marker of investor demand is actually, you know, what you see printed in the market, and you always wonder, you know, is there more or less? So I did like Caroline's point that saying, you know, the good pricing you see in the market of green bonds in particular, you can argue that there is a lack of supply and more demand effectively for that. But I was talking earlier this morning to a few investors, asking them, because, you know, you still hear that actually, yeah, even today you do have end investors that are not so keen actually on integrating kind of ESG in their criteria. And I'm always a bit, you know, not surprised, but wondering why. Yeah, because a lot of investors today, at least, you know, when you look at the proportion in asset under management, whether they are actually asset owner or asset managers, they have subscribed to the Net Zero Alliance. So they do have targets. Their targets are all encompassing effectively. And so you wonder, you know, they should want actually some assets that are decarbonizing effectively their portfolio. And for the asset owner, I was trying, you know, we always try to gather who are a bit the laggards, yeah, and so I would say the front runners typically, asset managers will tell you, you know, insurance, they are quite, especially in Europe, quite ahead.
AXA, Aviva, Allianz.
Yeah, AXA is a good example because as AXA investment management has kind of big mandates, and one of them is their own insurance. And some of the laggards sometimes can be surprising. So this particular kind of UK-based investor was saying some of the pension fund, they don't always integrate yet, which is counterintuitive because it's long-term. So that's when we'll have potential issues. Yeah? And you have probably kind of some difficulties at just kind of moving big institutions sometimes, and it is a bit of time. And that's where I think when you look at demand, and especially for green bonds, ESG labeled products more generally, the regulation in Europe. So I know, and I couldn't attend the earlier panels, probably there was a lot of detractors around regulation, and it's too complex and it's ever changing and you can't predict it at the moment. But still, it has a fundamental positive to me, that it really reconcile what market forces. The only thing really, at least in our market, that market forces cannot do today is reconcile the long term with the short term effectively. And the regulation is I think pretty good at that. And when you see, so under SFDR, so point taken that we don't know what it will look like and it will evolve, but at least as of today, you know, under SFDR, it is very supportive actually of green bonds. And actually, where before, yeah, you know, we talked about green bonds to very dedicated, sometimes investors. I've seen a few in the room already. Now, because of SFDR, pretty much every investor had to understand actually, you know, what a green bond could do for him and make it easier if they wanted to.
It's been a fantastic education tool, hasn't it?
Also, I mean, obviously, okay, one regulation, yeah, if you go into EU green bond standard, it's even more of an education.
EU green bond standard's an aspirational standard. No, even Paul Tang agrees.
I think now, yeah, there's
who led the work.
Yeah, but to me, I don't know if do you want to move to EGBS now? Or okay, we can.
No, sorry.
No, it's a big point. We
can have to say something. Sorry, I couldn't stop myself.
No, we can, because it's a big topic by itself. But no, on investor demand, briefly, what else? I feel you're right. I've been in this market for quite a while now. Definitely, there is a big, progress and continuous progress in sophistication in the whole market, and including on the investor side. If you think of all your institutions on the investor side, I'm sure that you can think of numbers that have increased in terms of ESG analysts, you know, resources that you dedicate, you know, data resources as well. And that's for what I find for the label bonds. That's really wonderful, actually, because you need that feedback from the investor base, and I call it kind of the feedback loop. I mean, and you need to kind of, exchange views. Okay, an issuer, and arrangers bring an issuer to the market with a certain transaction. There needs to be an exchange, and that primarily comes from investors. The press will relate what investors have told them, but they are not going to really, take a view. Investors need to share why they think they agree with that or don't agree. And there is a much greater sophistication on that front. Obviously, CBI, is very helpful in terms of, we had this question with Caroline this morning on the database, and a lot of investors are following it, and that's another element.
But it is extraordinary how, I'm going to say, every year for the last 12 years, people are saying this is going to drop off.
Okay, so on that point, because you were mentioning the trillions, so on that point, what I think is always, because and we at BNP Paribas and some other banks have this kind of targets in our public plans of how much stable bonds we are going to arrange, how much stable loans, and then obviously they are very closely tracked. And people ask, why in our graphs for the market overall years, or you see a drop, and like, look, we are dependent, maybe not entirely, but we are dependent on the overall bond market. If it's a year where you'll have less bond issuance,
yep.
Yeah, that does impact the overall volume. So that's why I don't think I like your optimism as ever, but for example, the 1 trillion this year, I think might be a bit difficult, but just the bond market overall hasn't fully recovered to the 2021 volumes. And the number we really like to look at is the percentage of ESG bonds in the overall bond issuances. And this year, again, if you look, EMEA is 20% of the bond issuance this year. 20% of the bond issues in volumes are ESG bonds. And that's 1 out of 5. So you remember, not that long ago, I was kind of, don't want the right term, but, peanuts, almost really. So that's the important measure to me to look at. What would be good is, of course, there is not 1 out of 5, but more, and that also it's more in the US. We are not there, especially at the moment.
But Standard Chartered told me that's the same percentage in ASEAN, 20%.
I think probably roughly the same, because the overall, I think it's about 13, if I'm not getting that wrong. Couldn't find it on my mobile earlier on. But the US is kind of waiting also because they have a big bond market. So they are not really, for political reasons mostly, they haven't got to the level we all kind of expected. But that doesn't mean I don't think it's a long-term thing on that side. I can pause there and we can discuss a UGBS.
No, that's good. And, the US will get there, but it's got a few problems to sort out first. There's no doubt about it.
But only, of course, they are still doing a lot. The IRA, the Inflation Reduction Act is effectively about supporting low carbon investments. It does take a bit of time in some instances, because we were discussing with some of our colleagues, some of the projects in the US that were being kind of paused, but so it takes some time to receive, the subsidies and so on from the IRA. So we have to see that as well. So.
And an indicator of what you can expect to see going forward is in a survey published a couple of days ago about a league table of financial centers around transition finance. Houston popped up. Houston, there's an oil gas center, and I'm thinking, whoa, that is going to flow on. So when you start seeing that happening, you realize there is something rumbling below the surface. And now we have to see.
I don't know if anyone has the answer to that. I didn't see that.
It was very interesting. So I'm very optimistic about the US going forward, especially because the IRA is benefiting Republican states. And so it's locked in as far as we can see. Yeah. And that'll lead to more opportunities for investors in this particular space. Yeah. But Pietro, you've been part of building up Main Street with others in the team over the last 10 years. It is now. This has gone from nothing to something quite substantial. Tell us your reading of investor appetite. Is this unquenchable, or are you about as big as you're going to get? Tell me. The leading.
Yeah, and yeah, thanks. And also, I wanted to extend a thank you to everyone who stayed until now. It's the last session, so really thanks for the effort of being here all day. And thanks also for the invitation. Actually, I think 10 years ago, I was just graduating from high school. So it's been a very, very quick way here. And just 5 years ago, I was actually part of CBI. So for me today, it's actually more of a reunion with a very, very large family. And most of you are here today. And that's very, very exciting. It's a small reality, but it's also one that's expanding very, very quickly. The Sustainable Finance Network, we can call it in many different ways, but I think climate bonds is really creating something unique, and it's unique in Europe, but probably extending worldwide in the future. In terms of building Main Street, yes, I cannot take that all of that. Of course, especially on the GSS bond side, Main Street has been there for quite a long time. The company was founded in 2008. Few of you might maybe not have heard this before. We are London-based, and already back in 2010, we were looking at GSS bonds very, very specifically. We were looking at all the deals that were pricing in the market because of this very deep connection we were building back then with fund managers. So really been hand in hand, walking this path together. And we have seen a lot of developments, especially in the recent year. So we're talking about acceleration, we're talking about much more data. So I would say, having been here at these conferences for a few years, the CBI conference, 5 years ago, we might be discussing of data not being here, where is the data? And I think today we do have the data, and Main Street is actually at the forefront of making that data easy to use for fund managers. And yeah, I can take maybe ownership a little bit of that slice of Main Street. But yeah, for sure, it's a very interesting space. I will take on what Agnes was saying before, 20%. It's a massive number. I mean, 1 out of 5. So for every €5 raised in the capital markets, 1 is through GSS. And I mean, for me, maybe 5 years ago was 2%. From 2 to 20, it's not an easy task. And I think it's really just we have seen a lot of demand from investors, and investors have been asking for more and more bonds and more complexity. So I think we wouldn't be talking about SLBs in so many sustainability-linked bonds in so many conferences. This year has been really a blooming of SLBs discussions, and that really shows how many issuers want to be part of this, even though they don't have the assets. I mean, not everyone can issue a green bond. I will never be able to do that. But SLBs give you that extra kick in terms of the market growth, which I think it's showing the maturity of this market today.
Fantastic. So what you're telling us is you are continuing to have appetite, demand from your clients to do this. That's the key message out of this, right?
Yes. Yes, for sure.
So we're going to come back to supply in a minute, but I first want to go to Jarek, who is recovering from being unwell, but has nevertheless got off his sickbed to join us online. Jarek, are you there? Can you hear me?
Yeah, I can hear you very well.
What are you seeing in terms of appetite? And I'm also particularly interested in you bringing in the Japanese and the Asian context, because I know you're working around the world.
Yeah, sure. I fully agree with Agnes that we need to look not just at the absolute number, but the actual percentage penetration of ESG bonds versus conventional. Because after pretty much 13 years of year-on-year growth, we are always talking whether the market will be growing by 20%, 50%, 80%. So I think we've got somewhat complacent, and suddenly 2022 was, since the inception of the market, the first year where there was a drop, which I think led to some overreaction and some slightly sensationalist reporting, saying whether this is the end of ESG and whatnot, and other headlines. But I think it's really important, because even in this down year, the ESG bond penetration actually increased. So continued growing. I also remain skeptical whether we're going to reach the 1 trillion mark. What I think, apart from purely focusing on quantity, I do think that quality of the bonds is improving. That there is a lot of work whether done through ICMA, through all the work with around improving SLBs to make them more material, more meaningful. All the guidance being released, and then a ton of work, and I guess that's where Japan kind of comes into this around transition plans. Obviously, CBI, I'll do a shameless plug. Published, the five key components of what constitutes a credible transition plan. So I think from where I sit, the bottleneck is not on the demand side. The money is lined up there. If you look at multitude of reports tracking fund inflows and outflows, and again, a shameless plug I would recommend to everyone is Morningstar, who does extremely in-depth analysis of the fund landscape. And again, even in the 2022, which was an annus horribilis both for equities and bonds, with performance being across the board 20-30% down, and money leaving towards purely cash, towards alternative assets, towards real estate. It was the only area that money kept where we were seeing net inflows were sustainable strategies. So even in the worst year in probably 4 decades for the space, there was still more money pouring in. So I do really think that the bottleneck here is in the available projects in the real economy, and hence I think there is a lot of focus on how do we not only look at the kind of binary static approach, what is green, not green, under many taxonomies, but the whole discussion around transition finance, which I think it is fair to say that Japan was at the forefront with. We heard from the METI representative earlier today from Shinichi Kihara about the GX sovereign transition bonds, which will be nearly $140 billion equivalent sovereign transition bonds, first in the world. But for this to be possible, the government over a number of years had to create a number of technology net zero roadmaps, going sector by sector, looking at 10 or so hard to abate sectors and creating pathways. I wouldn't limit this only to Japan, because in other jurisdictions, there are still methods to structure very credible transition finance driven structures. You can look at SBTI, you can look at IEA scenarios. I mean, there's a whole host of things that are there to allow you to hinge the structuring efforts. And I think, I do personally think that transition finance had a bad name, because we saw 5-6 years ago the kind of the transition bonds 1.0 version, and that wasn't well received by the market. And I think at the time it was understood a bit oddly. There's a great example which Ayla Cravey from EIB very often mentions is oil companies using renewable energy to power more oil wells and new drilling. So I would question whether that fits into any kind of definition of transition. So I think now it is really looking at decarbonization. And having said that, we do not expect a transition taxonomy from the EU over the coming years. At least we've got the European Parliament elections. We've got the end of term of the Commission, and I think a new transition taxonomy would take years, and similar to trying to create a social taxonomy will be fraught with all kinds of vested interest, political debate between member states, and but having said that, we've seen the EU very strongly endorse transition finance in June in their transition finance communications in the latest sustainable finance package, and both highlighting the importance of the topic and also highlighting that despite a transition taxonomy not being in place, there's all these other tools available in the toolkit, and especially using transition plans, which I know there's so many organizations at the moment working on creating frameworks and trying to define. So I do see the kind of growth in this space, but not necessarily in green. Although this year green has held unbelievably well. Where we did see a drop is in sustainability bonds this year, and in sustainability linked bonds, which again 2-3 years ago were a huge growth story, growing by a factor of more than 10. But this year versus previous years, it's on what around half the volume. So I do think we need to do more and more, and we need to do it quickly, because obviously, I mean, Sean, you highlight at every step the urgency of all of this, and growth has been great, but it's nowhere near obviously where we need to be, and that's even without going into climate adaptation, resilience, where the resilience gap is even greater. I'll pause here.
Your job to fix this gap of supply, Jarek. So along with Agnes here, but I'm very hopeful. But it's also the job of someone else, because I have a surprise guest, Paul O'Connor. I know you're over here, Paul. Come on up. Who's the head of EMEA for Sustainable Debt in JP Morgan and one of the world's leading green bond bankers. I'm going to bring him up on stage. How are you?
Good, thanks.
Your views, please, especially on supply.
Do I need a mic?
You will need the mic.
You're going to have to get a handheld mic from the audience. Someone's going to come to you any second now. We're very spontaneous here.
Thanks,
And
John.
I'll be coming to you for spontaneity in a minute.
So yeah, just a few quick comments from me. I think very much the theme this year going ahead will be reset of the sustainability linked format. It's been under some scrutiny and some strain, that's fair to say, but I think we've all
Including by us.
Yeah, that's right. Thank you, Sean.
But it's still good.
Right, exactly. If done properly, I think. But I think we're at a point now where we understand better how to do these things. And certainly our clients, I think, have internalized some of the criticism around the structure, and they're much more circumspect, and they're much more likely to say, look, when we're ready, we'll do this. When we have a strategy that's going to support it, when we have robust data, when we have a track record, when we know what we're doing, that's the time to go ahead. And I think that's going to be a positive for the market overall. And I think it's going to, I guess, counterbalance some of the criticism we've heard. I think it'll re-engage investors, and investors can see the value again. Hopefully that's what we're going to see. I would say also that the most carbon intensive sectors, they're big ships to turn, sometimes literally. It takes sometimes years to get all the shareholders and the stakeholders on board to commit to a change of strategy. That just takes time. And when all of that is done, then a sustainability linked bond can be the right instrument to communicate that change of direction. So I think, the market wants things to happen quickly, but the reality is in the real economy, we're talking about decades, in terms of time horizons, planning, new technology, capital, all of this sort of stuff has to be brought to bear. And so it does take time, but I think there's some good stories emerging, and hopefully we'll see more of those. And then the last point I just wanted to comment on was sovereign sustainability linked. I think every sovereign on the planet should be looking at whether or not a sustainability linked structure
You've just done one.
could work.
We
have done one, which we're very proud of. Uruguay, I would say, possibly one of the most valuable ESG label instruments out there. Again, we're a little bit biased because we're involved, but certainly in terms of what it demonstrates is possible. I think it's an incredibly powerful.
Tell us the detail. What is it?
So it's basically a sustainability linked bond. There's two KPIs. One is greenhouse gas emissions from the economy that reflects the Uruguay's climate targets under Paris. And the other is a commitment to maintain native forest, which again is quite an interesting sort of component to this. Basically, if they maintain forest cover at 100%, they get a credit in terms of a step down on the coupon. Obviously, if they fail that target, they pay up. So it shows how investors can share in the sort of risks and the rewards around these things. I think it's tremendously compelling. There is sensitivity around the idea of a step down from a fixed income perspective. Obviously, fixed income means fixed, and people don't necessarily want to hear that could not be fixed. But I think for certain types of investors, they do have the ability to look at these things. And, I think we will continue to explore these things, but I would highlight that one. We're aware of reports that other sovereigns are looking at sustainability linked. And that's great to see. Again, I would just say it takes time to pull together all the sort of arrangements and the building blocks to make these things happen. Not every government is in a position to do it. I think Uruguay has shown the way, and as well as other sovereigns. So it does take some time, but I think it's tremendously compelling in the sort of right hands, and hopefully we'll see more of them. So I'll leave it there.
Yeah, and I can't contradict Paul because we were on this transaction. So unfortunately, you want to have maybe a balanced view on the. But what was really interesting, and Uruguay is the only one, yeah, so far. And chatting with some of the investors in the books with the step down, effectively, because it's true that there's been a huge amount of discomfort, yeah, from the overall investor base, with a possible step down. I think maybe there is a specifics with EM though, where it's true that if you are an EM fund manager, you will be used to a variety of kind of, potential events, very, very specific clauses. There are sometimes links to ratings. So I would take would be you might see, or you probably will see more sovereigns in the EM space adopting this faster than you would potentially in more kind of, say mainland Europe and so on. And then when you start having a step down, and so, we, of course, we work together very often, and I'm not surprised by any of Paul's comments and really agree with those. In terms of really having strong structures for SLB, the minute you start including a step down is even more paramount, because for investors really here, okay, at the moment, if it's only a step up, well, the structure can be criticized, it wasn't robust enough, but actually there are not that many investors that, invest in those transactions hoping that, they get to step up and there is a slightly better remuneration. It can happen, but it's not really the spirit of it. The minute there is a step down, and it would appear that actually it wasn't as ambitious as everybody was thinking, that's going to be more problematic. So actually, your intro was perfect to lead to the way to say that, there could be more step down in the market, only if the structures are really robust effectively. And I'm very happy. I mean, I knew you wouldn't say otherwise, Bob, coming from you, but I'm really happy when people say, oh, market is robust enough and criticizing, you have banks like ourselves and many of our peers that have very kind of, lengthy discussions with issuers and saying, well, maybe this is not the right time. Yes, it's a great instrument. You should listen to Sean when he said it's a perfect instrument, but it is at the right time. And it's based on a very solid strategy. This is not going to replace your strategy. So
very good point. But of course, not just this LBs, is it? I mean, sovereigns. We heard earlier in the earlier panel, and Jarek reinforced it, about Japan's $130 billion climate transition bond program. Australia is coming to market for standard sovereign use of proceeds green bond, I believe, next quarter, but we'll find out. This is growing as well. I mean, and in Europe, what I hear from the sovereign issuers, they would like to do more. They just can't find enough things to use, which is a great pressure to put on the treasuries, right? They're hunting around, knocking on the doors of the Ministry of Energy and the Ministry of Climate Change and saying, what else have you got that we can finance for green bond?
Yeah, but in Europe it's quite specific because you have the EU green bonds, and a lot of the assets actually have been gathered for the EU green bonds issuance.
In the resilience
so we've
recovery
seen, we've seen quite a big shift in the volumes, and specific to Europe but in pre-EU green bond issuance and post on volumes. So
yeah, no, I also wanted to take a step back and looking outside from the sustainability-linked bond structures. I think they're extremely useful and interesting, as I said earlier. But especially looking at South America, I think it's really, really exciting to see how many green, social, sustainability bonds are coming out from that region. If we think about Chile, many people might not actually envision the long story they had in this market. They issued green, social, sustainability linked. Yep. So they're really just, they're very eager probably to learn from investors what is our interest and what are we looking for. So an SLB, it's probably the most actual, is what you're talking about a lot right now, rightfully, today and this year, last year, and who knows what's coming next. Actually, I also wanted to bring some data. I'm not gonna bore anyone. It's just, I think, more of a perspective. We can look at green bonds in the future. Our analysis really shows that issuers of green and social bonds from developed markets are channeling a lot of funds in developing markets. So if you look at the balance of money in the green bonds, comparing amount being issued, so you look at the geography from the issuer headquarters and compare that to where the money is actually being deployed. So the projects, where are these projects being deployed? You actually see that developing market, especially through supranational entities, are really channeling a lot of that money in developing. So I think that goes back to 2015 and that famous Paris Agreement, which put everyone together, or most of governments together, to decide that it's a journey we're going to do all together, and it's a journey that needs to take into consideration starting points and how emerging markets really should be supported in this transition. So I'm very happy to see this data as we work on it every day, and it reinforces the mission we're all here for. So really about those trillions you've been mentioning for some time.
I mean, it's not only that we support them, it's also that the returns there, getting the right risk-reward ratio to fit for clients in developed markets is, of course, always a challenge. But that was the conversation we were having earlier with Arun Sharma from the World Bank and others. These kinds of tools to deal with the risk barriers are big to happen. Paul, is that what you're seeing? You cover EMEA, which is much more than Europe. Do you see increased issuance from emerging markets at the moment?
Yeah, in fact, we've basically got a guy covering that whole jurisdiction now, and you know, he's extremely busy. I'm doing my best to help him, but there's a huge amount of work to be done in emerging markets, and arguably the impacts that can be created are arguably larger. It's so many things that need to be done. There's so many themes. There's more and more, I would say, funds, maybe not now, but there have been plenty of funds set up to look at opportunities in emerging markets. So there's a huge amount to do. It's almost a question of where to start. I think the things that we see that are encouraging are a recognition of the importance of helping governments to build capability, to measure things, and to create that sort of institutional capacity to provide information to the market. You know, what constitutes a green project? How do you demonstrate that it's green? You know, life cycle analysis concepts, you know, data, you know, helping governments create that kind of institutional capacity, I think is going to be very important, because investors need to do their due diligence and they need information. And if you can't give them that information, you know, it's going to be hard for them to, you know, to buy bonds and other sort of debt securities. So, you know, that work has to be done, and we are seeing it done, and we are trying our best to help with it. But there's a huge amount of work that needs to be done around that.
A question for you, Jarek. So opportunities in fixed income, what's the regulatory agenda, the market infrastructure issues to take this forward looking like for you?
So I think for the buy side, obviously the main thing at the moment is the SFDR consultation, which is open until 15 December, and I'm a bit more skeptical on the positive impact of SFDR than Agnes was. I think, you know, seeing the main buy-side clients, the most common gripe I've been hearing from portfolio managers were that they can't focus on doing the job they were hired because they were spending 60-70% of their time with legal compliance teams. Yeah, we've seen the wave of self-downgrades, then to see the European Commission do an almost 180-degree volte-face with not providing any kind of definition of sustainable finance, but sustainable investment, but mentioning that it is for each individual asset manager to define, but to be transparent about what definition they are using, to now the whole debate whether to scrap Article 8-9 altogether, or probably more likely to overlay it with similar what the UK has been proposing, with a number of fund labels. So actually create a labeling system and not use a disclosure regime the way the market has been using. So I think that will have where we end up on SFDR is going to obviously be reflected how the asset manager industry, especially in Europe, sets up the various strategies. And on the issuance side, obviously EU GBS. I think the take-up will not be stellar. I think we're going to see quite a range or fragmentation of green bonds, with some not claiming any degree of alliance, some saying that they're potentially aligned, but not showing that they satisfy do no significant harm, so not able to claim taxonomy alliance. Some issuers opting to elect what are now voluntary disclosure templates. These still haven't been released yet. So I think there'll be very, very few who will be able to actually issue fully EU Green Bond Standard compliant. Ideally, I would like to see those attracting a greater greenium, because in theory you should get the kind of the widest, even the strictest buyers still investing in as large size as they can if something's EU GBS aligned, because they can be sure that it's very impactful after jumping through numerous hoops to comply with the standard. So obviously it's a phase-in period. It still hasn't been published, and there's a 12 months vacatio legis before it comes into force actually. So I would say these two are I would say the main bits, plus I would say work on transition plans. And specifically in the fixed space, I think trying to find an alternative to SLBs. We know that there's regulatory constraints from the EBA and a number of other regulators having step-up instruments being treated as capital. So there was an alternative structure developed by Nordea. We're aware of another FIC client and another SSA client also looking to find this alternative structure where you could use a bond effectively to refinance the sustainability-linked loans which sit on the balance sheet of the issuer, extended in turn to their end clients. So I think that's one space to watch, because we might see another product emerge from there. Hopefully it will be harmonized and we won't see each issuer of these SLLBs trying to come up with their own variation of this, because I don't think that's what the market needs with already quite a plethora of labels out there. And then there's the interesting discussion, where transition bonds fit, whether this should be a subset of green bonds, and I think it's not only semantics or legal risks. If it is viewed as a green bond, which potentially could attract higher risk of mis-selling if someone buys thinking they're getting exposure to renewables, and they're getting in turn a bond that's financing ammonia, blue hydrogen, carbon capture, and so on. But it does have practical implications, because if it's a subtype of green bond, then it's green bond index eligible. Then you have the whole passive ETF buyer base able to buy it in size. So I think that's still a discussion that hasn't played out fully, but a pretty important one. And personally, we would like to see it as part of the green spectrum, not something completely.
Yes.
But and I'm not surprised, Sean, that you agree with that. It's not a surprise to me, but great to hear anyway.
No, that's absolutely our view. Now, your indulgence, please. Before we go to questions, I'd like you to spend a couple of minutes talking to your neighbour about what you see as the opportunities and the issues going forward. This is talking amongst yourself for 3 minutes. Make sure you get to someone you don't know. If you're sitting in a cluster of friends, turn behind, okay? 3 minutes, go for it. What are the issues? I want two issues or opportunities. You got
Very nice. You join this week, so it's a good time. Looking for a team.
Hey.
Ready, what not? We.
Thank you, everyone. Thank you for making it a bit fun at this last stage. Now I'm looking for a few volunteers for comments or about opportunities, especially where you see this market going. Who would like to kick off? I'm looking for some hands. We've got one here. I need a few hands, please, before I start distributing microphones around. We've got a few. Got one here, one back there, and at the back over there. Okay, I'm going to start up at the back. So microphone with that man with the gray hair. He used to have black hair, but it's gray now. Like me. Please. And then we'll go to the back over here. That hand up there. Introduce yourself, please.
Oh, yes. Thank you, Sean. So my name is Paul Camp. Sean and I met in a coffee shop a long time ago.
Just a random guy.
I did the first green bond under the Climate Bonds Initiative, and it was certified in 2014. So I'm trying to get credit enhancement for my projects. My projects are in emerging markets. There it is very, very difficult to get projects wrapped that are $1.5 billion. And I think that somehow we need to come together to get credit enhancement tools, more of those, especially with the insurance industry, so that I can unlock the projects, because I could easily deploy 500 billion and more across the projects that I've got. And I think that when I'm going to be issuing my green bonds, of course I'm going to do a verification on that, or second party opinion. Of course I'm going to try and de-risk it in whatever way I can on that asset. But the credit enhancement tools aren't really there.
Thank you. Over here.
Hi, Nav from GCS, part of Tata Group. I think one of the issues that we see when speaking to
Hang on, what's your title?
Sustainability Partner.
Thank you.
Thank you so much, Sean.
Just got to get it out sometimes.
So when speaking to financiers, one of the number one issues we hear is risk appetite, especially post GFC. Number two, conduct risk, and especially the UK's SMR regime as well. Should we be touching ESG, especially with poor data quality as well, scope 3 emissions? Is it plausible or not? Am I going to risk regulatory, legal, conduct and reputational risk? That's a big challenge at the moment, especially, and from my opinion, ramping up liquidity in green bond markets.
Thank you. I need a couple more at the back, please. One in the aisle here. Paul, maybe you can get that one. Got to use our speakers, right? Oh, okay, no, we're right. And have I got a couple more hands up who are going to speak at the back there?
Yeah. Thank you, Sean.
Paul, you can get this guy.
My name is Neha Kumar, and I head the South Asia Program for Climate Bonds Initiative. And this group basically talked about emerging economy perspective. And we thought that sustainability-linked bonds do show an opportunity, but there is more work need to be done on both the credibility as well as the integrating social aspects and social outcome aspects, and that SLB structures could be those mechanisms where the social could be more easily brought into the structure as well. So that was an option.
Hi, I'm Prashant. I'm from Climate Align, and we're developing AI tools for climate finance. My question is about, do you see any opportunities in terms of UOP splits? Like, are there any particular sections of the UOP from a green bond point of view that you feel are probably gonna expand the most in the next few years? And secondly, do you feel like with the emergence of frameworks like the TNFD, is there going to be more focus on nature-based solutions compared to climate? Thanks.
Thank you. Please stand up.
Yeah, hi, I'm Alex Lehman. I'm with Independent Economics in London. For me, the main takeaway is that transition finance is really coming to the fixed income markets. I'm heartened by the new climate bond standard in this area. The new task force on transition plans here in the UK, the EU framework on disclosures, I think will bring more consistency. What I wonder and what I would flag for discussion is that our governments are bringing more uncertainty to the economy-wide transition and their own net zero targets. And I wonder how in that context, investors, corporates, financial institutions can still have a consistent transition planning given the uncertainty that's in the policy, but also in our global climate scenario. So I'm hoping there'll be better consistency and alignment between public and private sectors.
Thank you. Stand up. Any hands over here? Sorry, this man first, then you.
Andrew Ross from Global Garden. It's a question for Paul. What is stopping your support for a sovereign green bond issued by HM Treasury based on TNFD?
At the back, please.
Hi, Colin Strasser, CEO of Montrose Software. A few of the different questions and the Uruguay bonds I thought sounded like they have a similar backstory or underlying thing, which is whether it's the reputational risk or the credit enhancement or the sort of the standardization. Do any of these sustainable linked bonds or the step down bond from Uruguay, for example, is there a role for rating agencies or ratings in general, more standardized ratings to play in that space so that it's more uniform and universal in the financial market to rate something on a sustainability or green basis and then have that play directly into the, if there's a step down, for example, or other credit enhancement rating type related categorization of the data or of the bond?
Interesting question. Last few more rounds. Any more questions? After all that chat, there must be a couple more in the audience. Okay, let's go back to our panel. We're looking at how we wrap all this up. And when the brief I had given the speakers is we want to know a bit about appetite. We want to know a little bit about supply, because it's very clear today there is more than enough appetite. You've all said that, or certainly speakers today have said that. But we've got some challenges in getting enough supply, where the supply is coming from, and then, of course, the regulatory environment, where it's going and how we're changing that, and then a few specific questions. Please dive in. And by the way, I don't see anything about JP Morgan not being supportive of a UK government TNFD bond if they want to do it. I think that's
yeah. Let me.
Have I missed a press release?
No. We're supportive of everything in principle. So to the question, we were involved in the UK sovereign green bond, and to my mind, it was presented very well. On the subject of TNFD and biodiversity and support for nature more broadly, the challenge tends to be spending enough money or being able to spend enough money. It sounds silly, but actually it's harder to spend money on nature and biodiversity promotion than you might actually expect. You could go the way that the Nature Conservancy have gone in the US and just basically acquire large land holdings and just manage them, let them rewild and manage them for nature. So, it could be done, But the question is, how are you going to get these land holdings? And would all voters believe that it was a good use of, what is ultimately going to be taxpayers' money? So in principle, I think there's no reason, but it's just hard to generate enough spending opportunities to do a bond solely based on nature and biodiversity. I can just cover off a few of the other points briefly. Sorry. On using SLB for social, yes, it can be done. Some social themes are easier. So healthcare, for example, we're looking at health impact bonds, which rely on measuring people's health via like cholesterol and blood. Things like that can be measured very reliably. Things like affordable housing, units, and jobs tend to be, the data tends to get a bit messy, and it's actually quite hard to use the SLB apparatus to support these things, because the problem is always, getting that line of sight and visibility over the spend and the actual outcome. So sometimes it can be a bit challenging to link some of those metrics to SLBs. And then on the ratings agency point, I think that's really interesting, because we, for a long time, have been trying to draw a clearer line of sight between credit risk and ESG issues. And I know the ratings agency have been working on this. So the holy grail for us would be able to justify a step down on a coupon based on a belief that achieving a particular target is resulting in less credit risk for the investor. So if we can draw a line of sight between credit risk and performance against a particular KPI and target, I think that would be something that could really help. And I think the ratings agencies have a big role to play in that. Quite difficult to do. For corporates, for example, you could say, well, if I'm successful at reducing my greenhouse gas emissions, I don't have to pay as much in the EU ETS market to acquire carbon credits. There's a clearer line of sight between credit risk and you achieving your targets as an issuer. But for other areas, it's more difficult. But I think it would be really interesting to explore that, whether we can create that linkage and create the support for it, in dialogue with investors. They were my kind of comments, so I don't want to go on too long, so I'll pause there.
Thank you. We might go to Jarek online, because he's very patiently sitting there. Jarek, I hope you heard the questions.
Yeah, which one do you want me to address?
I just want reflections at this stage, whatever you like. And given the conversation we've had about those questions, supply is what I really want to know about. I want to know where are we going to get more bonds. Look, my big problem, I'm going to tell you now, is, to be honest, I've got investors all around the world, every geography, including domestic India, domestic Brazil, who want green bonds and sustainable bonds. I can't get them enough. So that's the real question I want you to answer for me. Where's the 10 trillion of these things going to come from, Jarek? Quick.
I think factor-based sectors. I think we need to widen the spectrum, but do it in a credible manner, and obviously science-based, science-led. So go beyond green and look where the emissions are coming from, and that's where we're going to achieve the delta, because it's clear that if we finance all the green assets globally by green bonds, that's not going to get us to 1.5 or probably even 2 degree scenario. Try to be quick.
I meant quick, give me the 10 trillion, not necessarily the answer, but that was good. Agnes.
Me?
Yes.
Yeah. It has been, at least it was part of some of the questions. One of the elements, because in your 10 trillion, the latest kind of UN UNEP report on the adaptation financing gap, that's already up to 350 billion per year. So that's already part of where they think there are effectively needs for financing and is not being brought to market. The difficulty when you talk around, and you were mentioning it, for some, when you look at really a normal green bond as we are used to see them, there are not much in terms of adaptation of resilience being financed. We did few years back now a resilience bond with EBRD, but there are not actually that many. And one of the underlying problem is that really when you finance adaptation, or when you invest in adaptation, there is usually no cash flow attached to it. So in reality, you finance it now to prevent a cost in the future. And that's typically effectively, in terms of return of that investment, very difficult. So that links back to some of the questions on de-risking and blended finance. And it's true that really the MDBs today, probably, at the junction effectively where there is a lot actually of expectation on them to really kind of help find the solutions for this de-risking and that's part of the structure of the debt for nature transaction that have been done. So with TNT, but there is a de-risking in needed. And you can think of a lot of other transactions. Part of it is we don't really know how to price that well, actually, adaptation risk. And when you talk to insurance companies, and if there are any that I don't know if Sean will allow at the end, but in reality, when you tell them if I invest X, most often to what we've seen in adaptation, what will my insurance premium be, in the future? It should reduce. And that doesn't seem that this is still something that we can do and can price. And if you cannot quantify this, it's very difficult to finance it today. So that's what I would do. And someone was asking as well on sectors, on the more mainstream green bond is definitely, and that's where we wrestle a lot of us with, transition finance, transition bond terminology. Because actually some of it, we would really look at it as a green bond. Some of it, maybe it's more peripheral, and that's when APAC, that's where they have more need effectively. But if you look at, steel, well, actually in the EU taxonomy, it tells you, what kind of projects will actually be following the EU taxonomy and an investment in steel, same as cement. So that's where I picked up on Jarek, you were talking about the regulation. That's where, for me, the EU taxonomy regulation, at least from an arranger's point of view, not talking from the person that needs to disclose all of this, is very positive, because it gave all of us a reference point in addition to, the CBI standard. That was the only thing in the world pretty much at the time you could refer to. And that gives, in context of concerns around greenwashing, are we all doing the right thing and so on, being able to relate to texts that have been, sometimes they're political element, but still they have been developed with broad consensus. That's very helpful. So really hard to abate sector. In some cases, not all, I would agree, but within specific areas, you would see them coming potentially to a green bond market.
I think the taxonomy, your points are really well made around the taxonomy. It's a work in progress. We are, because I'm involved in the platform working on it, along with BNP Paribas reps in the past, still learning by doing. But the power of it, when I was giving speeches in Budapest and Bratislava early this year, and there were banks coming up to me saying, we've been investigating the taxonomy, asking questions. And then I said, is this working? And they said, yes, it's got everyone at the bank talking about sustainability. The ripple effects of this common language, which is not what we've seen in ESG. If you look at the top 500 companies in an MSCI matrix, the top 500 companies in a Sustainalytics matrix, they don't match different ESG models. This is a common language, at least. It needs work. We're working on usability, but...
Well, the way I always explain it is that it's a common dictionary. And Elena Vinicius, at the time she was with us, was actually using that term. And it's really a common dictionary. And then at least we all know what we are talking about and how far we are from that definition. Doesn't mean that everybody will agree with it or we align with it, but at least we have a joint wording, a joint definition, and that's much easier to then agree or disagree. And how far do we disagree? That's really what has changed.
And it is important to note that this shopping list for a future idea has gone viral. We now have 50 countries around the world who've said, oh yeah, that's a good idea. They're starting doing it. And we've had a particular win, a little secret win, is we've managed to make it science-based in every country. Yeah, there are arguments about the science, but it's not policy-based. National climate change plans have been policy-based, weakened in lots and lots of places by the Ministry of Finance saying, oh, it looks too hard to me. What about we just do this? We've managed to bypass this here. So this is a very important advance. But of course, it's still a work in progress. As Pietro, representing the investment community on this particular panel, might agree. But your final reflections.
Yeah, thank you. And with my answer, I'd like to touch on a few different points, namely biodiversity, then sustainability-linked bonds with social KPIs, and then, of course, CO2. from my position, I think it's interesting to see how, especially when we talk about adaptation. So we're talking also about, I would say, in a certain way, biodiversity. We need to think about, as we say, who can actually provide us those assets. Out of all the green proceeds out there, 7% are dedicated to adaptation. 7%. That's not 70 as we might need.
No, but it is 7%.
7%. It's not bad, but we could have more.
The Netherlands sovereign bond was first one was an adaptation bond.
Exactly, I think
10 billion euros.
Yeah, and 75% it's coming from governments. So we see who can actually play specific roles in the picture. So that is very important to see from the issuer side. And I think it should also lead towards more education in terms of how some actually from the panel, someone commented what it is actually that we're financing. From the investor side, sometimes we try and synthesize, make things more synthetic and put them together, and biodiversity just looks like a very big basket of complicated assets that are very reductive to be considered just under a CO2 umbrella. As we said, CO2 is about looking forward, especially when we think about biodiversity. So I think it's struggling a little bit to fit within the environment where we're looking for data and quantifying this. On the social bonds, actually sustainability linked bonds with social KPIs, our research shows actually that quite a few of the KPIs are showing actually, I think, drawing the attention to what the issuer can build up in time. So some KPIs that we're seeing can show a continuous, let's say, effort from the issuer. We're talking about how many patients have been treated. That is not something that you can change from one day to the other. Other KPIs that we're seeing in the sphere are, for example, percentage of female in a board. That actually can change in a relatively short period of time. So it's an interesting segment, and we really try and understand how much we are talking about journeys and really bring the investor and the issuers in the journey with us. It's relatively easier to talk about transition in the environment. I think we should try and channel more resources in talking about what is equivalent in social, because we do not have a social taxonomy. And I think environmental taxonomy is really teaching us about emissions, CO2 emissions. You know, climate change mitigation is the most technical and quantitative criteria we have out there, and it's about reducing greenhouse gas emissions. While we don't have a social taxonomy, so it's really complicated how to frame issuances on the social side, and also how to tackle them from the investor. So it doesn't surprise me to see 75% of KPIs in the S&P market linked to CO2, because that is what we learned to analyze. And again, probably from the crowd, we had questions about scope 3 emissions. And I think that's a very interesting topic, and one that is taking more and more room in sustainability linked bonds, which is, of course, welcome for us. My last point is about ratings. I do think that ratings should have a subjective component in terms of the investor. So we're seeing differences, also wide differences based on the provider you're looking at. And I think that really speaks to the users. We're talking about materiality. What does really matter to me? If I shape a fund in a specific way, maybe I would like to tilt my attention towards CO2 more than other topics. So ratings should be seen as, of course, ESG ratings, as a tool to quantify what is for you a risk, ESG or greenwashing risk. And I think that variety really channels discussions and makes our environment we live in more and more interesting.
Interesting.
Yes.
May we live in interesting times. We need to finish. The transition has clearly started. There is no doubt in the conversations you've heard today, in looking at the science, in looking at the IRA, the GX plan, etc., it started in the low carbon area. We've had a discussion today about how it has to start in the resilience area. We're just getting going in our frameworks and thinking 7% of bonds, for example, it needs to be 50%, just in terms of the volume we need to invest in this transition. So we've got a long way to go, but it has started. We've got a challenge because we're entering into a century of volatility. Well, probably a lot longer than a century, but it's certainly going to get to be a rougher ride going forward. So we have to prepare for that and try and make it smooth, because every time there's a big speed bump, there's a big chance of a massive rollback in terms of gilets jaunes, for example, or whatever it might be around the world. This is why just transition is important. This is why addressing the social side, and by the way, also the nature side, is so important, because every time there's a crisis, fragile ecosystems collapse and they don't come back. If they are healthy, they've got much more chance of surviving crises. We have to prepare. But whatever, there is a tsunami of change already coming through the world system. We've seen it in electric vehicles. We've seen it in renewable energy. We're now beginning to see the beginning in steel, in cement, in other industrials, and so on and so on. Risks. There are risks of missing out. There are risks you're going to get caught with stranded assets. There are risks from climate impacts that we have to address. But of course, in this period, there's enormous opportunity. For institutional investors who are relatively risk adverse, it's going to be tough to take advantage. Sure, they can increase their allocations to venture capital and private equity, who will play the wave. But what we're going to need to smooth this transition, which is what institutional investors need, is a close cooperation and collaboration with the parties that have some chance of smoothing it. That does mean development banks. That does mean governments. That does mean the public sector. That does mean us operating together as a community. So you're going to see in the next short period, three things. One is evidence of that cooperation and collaboration growing. The IRA is an example of that. The Japanese climate transformation plan is absolutely an example of that. But let me commend to you what Singapore is doing, where the Singaporean government has been saying to all its ministries, they need to start looking at CapEx plans in line with the new Singapore taxonomy. This is, of course, creating terrible difficulties for the ministries. Really? Got to be in line with the taxonomy? That's the whole point. And that is these tough discussions. And not to mention the sovereign wealth arms, GIC and Temasek, who are now investing to try and meet Singapore's climate goals. But this is happening in Denmark too, where every single ministry now has a committee looking at how that ministry can contribute to achieving their very tough 70% reductions in emissions by 2030 targets. Every government needs to be doing this. Every government will be doing this. It's a matter of just how quickly it actually happens. This is something important to note, that cooperation and collaboration, we know from studies of resilience, are predictors of resilience. Like I said right at the beginning of today, in earthquake recovery studies in California, the mortality rates have been at least 40% lower in communities that have a strong community. If the community is not strong, more people die. That is also what's going to happen at a global level. If our global community is not strong, doesn't learn to better collaborate, doesn't avoid stealing PPA equipment from the tarmac in Bangkok as Donald Trump ordered in the middle of the pandemic, if we don't avoid those things, more people will die. If we can collaborate, including with things like food stocks, the World Health Organization's delegated authority, the allocation of reserves to be able to deal with crisis in terms of financial reserves, all of these things, we have a chance of being able to make this a relatively smooth transition. The second point I want to just drive home to you, the lesson we've learned from new technologies over the last 50 years, scale drives learning rates. The more we can create scale demand, the faster the price drops. That's the lesson of solar. That's the lesson of wind. That is what I'm being told by the sustainable aviation fuel manufacturers. Neste tell me, you give them a large contract, they will drop the price of sustainable aviation fuels to the equivalent of kerosene really quickly. They just need a large contract. Every sector looks a bit like this. That's what governments can engineer. Governments can sometimes have to work around competition laws. They can aggregate demand. It may not actually require any money. It might require close working relationship with all the airlines. The 3 Chinese airlines got together, that could make a huge difference. If Singapore Airlines does a deal with Lufthansa and ANA, that could maybe do it, etc. Lastly, we need to see climate bonds will be working hard at this, as I know our banker friends will be, making it easy to act. You know, in a crisis, if it's hard to act, nothing happens. If it's easy to act, people jump fast. We need to make sure that bonds are easier, not caught up in paperwork. I agree with Ursula von der Leyen's campaign slogan, reduce red tape. Now, we mustn't reduce red tape by sacrificing ambition. That would be an own goal. But we have to make it easy to act, easier to act on everything. That requires everything, analysis of government policy around building procurement. That requires discussions around how finance moves, everything. Make it easy to act will be the theme of this coming year. Sustainable returns. Returns that can pay my pension, but also Paul's pension, and Agnes's pension, Pietro's pension, depend on a sustainable planet. No sustainable planet, those returns will not be there. That's the big lesson of where we are. We in this room, we are lucky because we have a chance to work on this issue. We have the privilege of being able to work on this issue. The bulk of the world's population will have to take what's dished out to them. There's little they can do. They will be dealing with rising sea levels, with heat, as Kathy Bowman-McLeod spoke about earlier, with economic disruption, with wars, with pandemics, with famines. We can do something. We must do something. We will do something. Thank you for being here today. Thank you for the work you're doing. And I look forward to success because there is no other choice. Thank you. Thanks for joining.